Preparing for a sovereign wealth fund investing at Qatar Investment Authority QIA interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like and share, and drop a topic request in the comments. Question 1. Why do you want to work at QIA, and how do you understand its mandate? QIA is not just an investment firm, it is a sovereign wealth fund built to convert Qatar's resource wealth into diversified, long-term financial assets. I would frame its mandate around intergenerational wealth preservation, disciplined global allocation, and strategic exposure to sectors shaping the future. What attracts me is the combination of institutional rigor, global deal flow, and a genuinely long investment horizon, which changes how you evaluate risk, compounding, and partnership quality. While answering, focus on QIA's role as Qatar's sovereign wealth fund, its long-term intergenerational mandate, global diversification objective, and why patient institutional capital attracts you professionally. Question 2. How is a sovereign wealth fund different from a private equity fund, pension fund, or endowment? A sovereign wealth fund invests national capital, so its objectives combine financial return, resilience, and long-term strategic diversification. Unlike a private equity fund, it is not forced to exit within a fixed fund life. Compared with a pension fund, liabilities may be less contractual, but public accountability is higher. The key distinction is horizon. A SWF can hold through cycles, allocate across asset classes, and use patient capital where shorter-term investors may be constrained. Make sure to cover capital source, investment horizon, liquidity needs, accountability, return objectives, and why a sovereign wealth fund can behave differently from closed-end funds or liability-driven investors. Question 3. How would you think about building an asset allocation framework for QIA? I would start with the fund's mandate, liquidity needs, risk tolerance, and role in Qatar's broader balance sheet. Then I would allocate across public equities, fixed income, private equity, real estate, infrastructure, and alternatives, using expected returns, correlations, drawdown behavior, and currency exposure. For QIA, diversification away from hydrocarbons matters, so I would stress test commodity-linked shocks and global recessions. Asset allocation is the biggest driver of long-term outcomes. In your answer, talk about mandate-driven allocation, liquidity, risk tolerance, diversification away from hydrocarbons, asset class mix, correlations, stress testing, and the importance of long-term strategic allocation. Question 4. Walk me through how you would evaluate a direct investment opportunity for QIA. My first step is to understand the business model, revenue drivers, margins, market structure, and competitive advantage. Then I test valuation through trading comps, transaction comps, and a DCF or LBO-style return case, depending on control and leverage. I would assess management, governance rights, exit routes, ESG issues, and geopolitical sensitivity. For QIA, I would also ask whether the asset improves portfolio diversification and fits a patient capital ownership approach. Be sure to mention business model analysis, market structure, valuation, management quality, governance rights, exit options, ESG or reputational concerns, and whether the deal improves QIA's portfolio construction. Question 5. What characteristics would make an infrastructure asset attractive to QIA? Infrastructure is attractive when it offers stable, inflation-linked cash flows and essential service characteristics. I would look for regulated or contracted revenues, high barriers to entry, predictable capex, and downside protection under stress cases. For QIA, airports, utilities, digital infrastructure, and energy transition assets can match a long horizon. The key is not just yield, it is whether risk-adjusted returns survive regulation, volume shocks, refinancing risk, and political change. While answering, focus on contracted cash flows, inflation linkage, barriers to entry, essential services, regulation, capex requirements, political risk, and why infrastructure suits a long-term sovereign investor. Question 6. How would you value a private company that QIA is considering investing in? I would triangulate valuation rather than rely on one method. Trading comps show market sentiment. transaction comps reflect control premiums, and a DCF captures company-specific cash flow potential. For a private company, I would adjust for illiquidity, governance rights, leverage, and quality of earnings. If QIA is taking a minority stake, I would also value protections, board rights, exit rights, and alignment with sponsors or founders, because governance can materially affect realized returns. Make sure to cover DCF, trading comps, precedent transactions, quality of earnings, illiquidity discounts, control versus minority rights, governance terms, and why valuation must link to realizable returns. Question 7. If senior stakeholders liked a marquee asset but your analysis showed the price was too high, how would you handle it? I would separate strategic attractiveness from price discipline. A great asset can be a poor investment if the entry multiple embeds unrealistic growth. I would build base, downside, and upside cases, identify break-even assumptions, and show the implied IRR sensitivity to exit multiple, margins, and capital expenditure. Then I would propose mitigants, such as staged investment, downside protections, or partnering with an operator. The recommendation should be evidence-based, not simply negative. In your answer, talk about separating asset quality from valuation, using sensitivity analysis, communicating downside risk professionally, proposing alternatives, and maintaining investment discipline without appearing rigid. Question 8. Which macro factors matter most for QIA's global investment portfolio today? I would focus on rates, inflation, currency movements, growth dispersion, energy prices, and geopolitical risk. Higher rates affect discount rates, refinancing costs, real estate cap rates, and equity multiples. Currency matters because QIA invests globally, while Qatar's economy is tied to the rial and dollar framework. I would connect macro views to portfolio construction, duration, sector exposure, regional allocation, liquidity buffers, and stress tests, rather than making abstract forecasts. Be sure to mention interest rates, inflation, currencies, energy prices, regional growth differences, geopolitical risk, valuation multiples, liquidity conditions, and how macro views translate into allocation decisions. Question 9. How should ESG and climate considerations be integrated into QIA's investment process? I would treat ESG as both a risk lens and a value creation lever, not a checklist. Climate exposure can affect regulation, CapEx, customer demand, insurance costs, and terminal value. In due diligence, I would assess emissions trajectory, transition plans, governance quality, labor practices, and reputational risk. For QIA, responsible investing also protects long-term national wealth, so ESG should be integrated into underwriting, ownership engagement, and exit planning. While answering, focus on ESG as financial risk and value creation, climate transition exposure, governance quality, reputational risk, long-term ownership responsibility, and integration into diligence and monitoring. Question 10. How would you decide between investing in a public equity position and a private market opportunity? Public equities offer liquidity, transparent pricing, and easier portfolio rebalancing, but less control and potentially shorter-term market noise. Private markets can provide governance influence, access to differentiated assets, and illiquidity premium, but require deeper diligence and longer holding periods. I would choose based on expected alpha, control needs, liquidity cost, and conviction. For QIA, both matter. Public markets provide scale and flexibility, while private investments can compound patiently in scarce assets. Make sure to cover liquidity, control, transparency, valuation, governance influence, illiquidity premium, holding period, access to differentiated assets, and how each investment type serves portfolio objectives. Question 11. What would you look for when evaluating a co-investment alongside a private equity sponsor? In a co-investment, I first assess the sponsor's track record in that sector and whether economics are aligned. Then I evaluate the company independently: market, leverage, value creation plan, downside case, and exit path. I would pay close attention to information rights, fees, governance, and whether QIA is receiving adverse selection or genuine partnership access. Co-investments are attractive when they reduce fees and deepen relationships without compromising underwriting discipline. In your answer, Talk about sponsor track record, alignment of interests, fees, adverse selection risk, independent underwriting, governance rights, leverage, exit path, and relationship benefits for QIA. Question 12. How would you assess geopolitical risk in a potential investment? I would not treat geopolitical risk as a vague headline risk. I would map concretely how it affects cash flows, ownership rights, regulation, sanctions, taxation, and exits. For each jurisdiction, I would look at rule of law, foreign investment rules, currency convertibility, and public sentiment. Then I would price the risk through higher return hurdles, structural protections, diversification, or avoiding the deal. At QIA, reputation and sovereign relationships are part of the investment risk equation. Be sure to mention jurisdiction risk, regulation, sanctions, foreign ownership rules, taxation, currency convertibility, social license, exit limitations, reputation, and whether risks can be priced or structured around. Question 13. How would you analyze a real estate or hotel acquisition for QIA? For real estate, I start with location, asset quality, tenant or guest demand, lease structure, and replacement cost. In a hotel case, I would analyze occupancy, ADR, RevPAR, operating margins, CapEx needs, brand strength, and tourism trends. Valuation would use NOI, cap rates, comparable transactions, and a discounted cash flow. For QIA, trophy status alone is not enough. The asset must produce acceptable risk-adjusted returns and portfolio benefits. While answering, focus on location, asset quality, revenue drivers, occupancy, ADR, RevPAR, NOI, cap rates, CapEx, brand strength, tourism trends, and risk-adjusted returns beyond trophy value. Question 14. Pitch a sector QIA should consider allocating more capital to over the next decade. One sector I would highlight is digital infrastructure, data centers, fiber, and tower assets. Demand is supported by cloud migration, AI workloads, streaming, and enterprise digitization, while supply can be constrained by power, land, and regulation. The attraction for a long-term investor is recurring revenue and inflation-linked contracts. I would still underwrite energy costs, customer concentration, technological obsolescence, and valuation, because the sector is popular and pricing can be aggressive. Make sure to present a clear thesis, structural growth drivers, why the sector suits patient capital, key risks, valuation discipline, and how the exposure would diversify QIA's portfolio. Question 15. How would you handle disagreement in an investment committee discussion? I would handle disagreement by bringing the discussion back to assumptions, evidence, and decision criteria. If someone challenges my recommendation, I would isolate the disputed variable, market growth, margin expansion, exit multiple, regulatory risk, or management execution. Then I would show sensitivity analysis and explain what would change my view. In an investment culture like QIA's, the goal is not to defend ego. It is to protect capital and improve judgment. In your answer, talk about intellectual honesty, evidence-based debate, isolating key assumptions, using sensitivities, listening to challenge, avoiding ego, and protecting capital through better decision-making. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.